Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market Update 20260430. This video presents a direct informational narration of the source document. Let's dive right into today's data-driven breakdown.
Here is the roadmap for today. We're going to start with indices and milestones, then look at the macroeconomic data and market breadth. After that, we'll dive right into big tech earnings, followed by industrials and pharma, and finally wrap things up with financials and hardware.
All right, Section 1. Indices and milestones.
Okay, so the sheer scale of these April gains, it is literally incredible. Both the S&P 500 and the NASDAQ just smashed right into new all-time highs. The S&P broke through that 7,200-point threshold, racking up a 10.4% monthly surge. To put that into perspective, that's its best monthly performance since the pandemic bottom reversal way back in April of 2020. The NASDAQ, it climbed 15.3%, completely wiping out 3 straight months of negative monthly candles, and the Dow advanced 7.14%. But here is the truly staggering part, right? Think back to April 2020. We had 0% interest rates and massive quantitative easing. Today, we are setting these records against a 10-year Treasury yield sitting at 4.3%. So what's overriding this high-yield environment? Simply put, exceptionally strong corporate earnings.
Moving on to Section 2, let's unpack the latest macroeconomic data. So what exactly is the data telling us right now? Well, the March PCE price index rose 3.5% year over year. That's a pretty significant jump from the previous 2.8%, drifting further away from that 2% policy target. Month over month, it rose 0.7%, actually the largest single-month jump we've seen since June of 2022. Now, this was heavily driven by energy price volatility. You know, high oil prices trickling down into fuel, production, and transport costs. However, core PCE, which strips out the noise of food and energy, came in at 3.2% year over year and 0.3% month over month, hitting estimates right on the nose. Meanwhile, Q1 GDP growth came in at 2.0%. Yeah, it's slightly lower than the 2.2% expected, but still a really solid rebound from the 0.5% we saw in the fourth quarter of 2025, heavily fueled by AI investments and the post-shutdown recovery. But guys, here is the real surprise. Jobless claims came in at a remarkably low 189,000. That is literally the lowest level since September of 1969. It points to a highly stable labor market, one defined by low hiring for sure, but also incredibly low firing.
All right, Section 3, market breadth and technicals. Okay, so all that macro data we just looked at, it essentially created a Goldilocks reaction. It eased recession fears without sparking outright inflation panic. Because of this, bond traders closed out their hawkish rate hike bets, treasury yields fell, and we saw a really noticeable sector rotation. For instance, the Russell 2000 jumped 2.16%, outperforming the major indices, which signals that market breadth is finally improving, beyond just the big tech giants. We also saw the VIX drop below 17, reflecting some very strong risk appetite out there. And on top of all that, an estimated $23 billion in pension rebalancing sell pressure, it was basically effortlessly absorbed by mutual funds engaging in end-of-month window dressing. And that really helped push the S&P 500 right above that critical 7,200 level.
Looking at the technical setup here, closing above 7,200 significantly boosts the probability of an early May sprint right toward that 7,240 to 7,250 range. Actually, based on projections from Bank of America, this current rally might not top out until it hits the 7,308 to 7,377 zone. So the main structural takeaway, it's just too early to bet on a pullback or a broader market correction until the index either hits that 7,300 ceiling or completely breaks down below its 10-day moving average support.
Moving right along to Section 4, big tech earnings and strategy.
Now, Apple is in a completely unique position right now. Q2 revenue hit $111.2 billion, beating estimates, led by a record-breaking iPhone revenue of $57 billion. Earnings per share came in at $2.01. But honestly, the absolute standout headline here is their massive $100 billion stock buyback program. It's fascinating, really. While other tech giants are burning cash in this massive AI arms race, Apple is just operating as a highly profitable toll collector. They aren't directly battling in the trenches of AI infrastructure. Instead, they are the ultimate user distribution platform. Whoever builds the best AI is inevitably going to need to access Apple's ecosystem to actually reach the users, right?
This strategy lets Apple monetize the technology without bearing the heavy capital expenditure risk. Well, provided that AI doesn't eventually bypass operating systems altogether, of course.
Just briefly interjecting a critical geopolitical update here because it directly impacts those energy inputs we discussed earlier. Oil remains elevated above $100 a barrel right now. The market is anticipating a drop in the coming months, but tensions remain incredibly high. Israeli Defense Minister Katz stated that while supporting U.S. diplomatic efforts, military action against Iran may soon be necessary to secure Israel's future. Concurrently, the CENTCOM commander is briefing Trump at the White House on further military options, which is definitely keeping oil traders in a very tight holding pattern.
Let's pivot and look at Microsoft and Meta because the contrast is wild. Microsoft shares actually dropped 4%. And ironically, in previous quarters, they were punished for spending too much. This time, they were punished because their capital expenditure growth unexpectedly slowed down, from 66% to 49% year over year. The underlying issue here is that the return on investment for Copilot still remains pretty unclear. That's shifting the narrative to Microsoft simply being a compute provider rather than the ultimate AI ecosystem winner. On the flip side, Meta stock dropped 8.65% despite posting excellent fundamental revenue and free cash flow. So why the drop? Wall Street punished Meta for excessive AI infrastructure spending because unlike Microsoft or Google, Meta doesn't have a cloud computing division to immediately offset and monetize all those hardware investments. Add in Meta's plan to issue up to $25 billion in bonds, and yeah, the market was notably displeased.
Google, meanwhile, gapped up to new all-time highs, and their journey is like a textbook example of a classic Wall Street narrative cycle. Initially, Wall Street heavily promoted this collapse logic, the idea that AI would completely destroy traditional search. That caused a severe price drop and massive valuation compression. However, as it became super clear that AI was being integrated as a search enhancement rather than a replacement, making ad targeting even more precise, the entire narrative shifted. The stock repaired and just surged to new records. This cycle of shifting narratives, from predicting the demise of Meta's advertising to Google's search to now questioning Microsoft's AI returns, is absolutely a defining structural feature of market rotation.
We also saw NVIDIA take a counter-trend drop recently. Now, the market pointed to Microsoft's CapEx slowdown and Qualcomm entering the custom chip space as the primary reasons for this. But let's be real, these narratives are very often just convenient excuses for institutions to take profits after a massive run-up.
Okay, Section 5, Industrials and Pharma Earnings.
Let's check out Caterpillar. They delivered a comprehensive beat and actually raised their full-year revenue guidance to low double-digit growth. Q1, total revenue jumped 22%, with net income up 27% to $2.55 billion. The construction division surged 38%, but crucially, the power division also grew 22%. This is the division that sells generators and gas turbines, right? And its growth is being directly turbocharged by the massive electricity demands of all these new AI data centers. Furthermore, Caterpillar noted that their tariff impact estimates have been reduced from $2.6 billion down to around $2.2 to $2.4 billion. That eases cost pressure significantly, sending the stock up 56.3% year-to-date.
Eli Lilly also reported exceptional numbers. Revenue hit $19.8 billion, which is a 56% year-over-year increase, while net income absolutely skyrocketed 168% to $7.5 billion. This massively beat expectations and led to raised full-year guidance, almost entirely driven by their GLP-1 weight loss drug portfolio. From a technical point of view, though, the stock is currently battling resistance right at its 50-day moving average after a 25% pullback from previous highs. Holding this gap up is going to be absolutely critical to maintain that upward momentum.
And finally, Section 6, Financials and Hardware.
We are seeing a really fascinating contrast in market reactions here. MasterCard reported solid top-line revenue growth of 16% and net income growth of 18%. However, if you look beneath the surface, cross-border transaction volumes and U.S. regional growth actually showed some deceleration, which caused the stock to give up its recent gains. Conversely, storage leader SanDisk delivered absolute blowout earnings and exceptionally strong forward guidance. But what happened? The stock still dropped in after-hours trading. This is just a super clear indication of funds electing to secure profits after a substantial prior run-up, regardless of how strong the actual numbers were.
So, as we close out this data cycle, the defining question really is this: will strong underlying corporate fundamentals ultimately override this short-term profit-taking? The data points to massive revenue growth and highly resilient economies. But navigating this market means you have to focus strictly on those underlying earnings rather than getting distracted by the shifting daily narratives. That wraps up today's Explainer. Thank you so much for joining, and let us know what you think down in the comments.